Okay, let's look at this slightly more complex example of a debenture or a bond. 20,000, 6% 4-year bond. That means the coupon is 6%, i.e. the interest paid to the loan, the lender, will be 6% per year of the 20,000. The bond was issued at a discount, 10%. It'll be redeemed at a premium of 1015, and we're given the effective rate of interest of 12%. We're also told there's an issue cost of 1,000. So the first thing to work out is it a simple amortized scenario, or is this being held for trading and will be put straight through to profit and loss? Well, there's no indication otherwise, so we're going to assume it's just amortized, like it's a simple debt that we either hold or have given to a lender. So let's put in the numbers that we know. First of all, a bit of a calculation involved of the starting amount. We start off with 20,000, but it's issued at a discount of 10%, so we have to take off that 10%, and we also have to reduce the take off the costs. Oops. So that gives us a starting amount of 20 minus 2 minus 1, 17,000. So we know that's the amount we're going to start with. Let's just put this somewhere convenient and just put it there maybe. Okay, so we could start off with this opening amount. Now, how much do we put to the profit and loss? This is quite simple. It's not going to, or the calculation isn't going to change. And we put through the effective rate of interest. And that means we've looked at the whole picture of the loan. And we've looked at the repayments, we've looked at the discount, we've looked at the premium, and we've calculated all that to be given an effective rate of 12%. And that's the amount we put to the profit and loss. That's the finance charge overall to the company. So that is going to be plus 12% times the opening balance, £2,040. And that's the amount, as I said, goes to the profit and loss. Now that's different to the amount paid out to the investor. He's got a 6% bond on a £20,000 loan. So he's going to get 20,000 times 6%. And that's not going to change. That's going to be the same every year. He gets the same coupon. Now, let's have a look at this. Started at the opening balance to the account was 17,000. There's interest added to that because we've taken a year to pay it back. So obviously this is going to increase this balance. But at the same time we've paid some money back. So this is going to decrease this balance. So we'll make this amount negative. We've paid back 1,200. The interest is 2. So obviously we're paying back less than the interest. So we'll notice that the balance is going to increase every year. So we just add that up. And there we go, that's the first year balance, 17,000. Started off at 17, increased by the interest amount of 2,040, paid out 1,200, giving a balance of 17,840. So we can then quite easily just copy this down to do the second year. So that's the second year numbers. This has increased because the opening balance has increased. So we're paying back more, and this makes sense because the interest is increasing faster than we're paying it back, and it's accumulating. So we'll do the third year, and we'll do the fourth year. So that was quite easy. So let's have a look. The interest payments haven't changed. That's 6% of 20,000 every year. But what happens in the last year? We need to pay back the principal, and we also need to pay back the premium, which is 1015. So in this period, at the end of the debt, we've paid back a total of 22,215. So if I add these three up, plus this, plus this, plus this is just an no, hang on a minute. What's going on here? Not letting me take that one. That is on my screen. This. So this is just 22,215 paid out back to the lender in the final period. And if we add all this to the, effectively do it like this, we're going to sum all these together. It should give us 0. So what I've done there, I've summed the opening balance, added the interest, and then I've taken out all that we paid back, and these three will add up to these two. 19,8 plus 2,3 comes to around 22. 22,215, as do these 21,200, 22,215. So the balance is 0, which is what we want to see nicely, tidily closed at the end of the trade. So that's the first thing. Well, the first thing is to find out whether it's amortized. Is it a simple debt held to the end? And it is. So that's the process we followed. The debt to the P&L, the interest charged to the P&L rather, is the effective interest. So that includes all the costs, which we can do here. Let's just make another little schedule. This was the opening, and this is costs, total finance costs. Well, we have all the interest payments, so it's 4 times 1,200. Perhaps I can move this along slightly. Get a few labels on there. So this is interest, 4 times 200. We've paid at a discount, so there's a discount price to pay. And the discount was 10% of 2,000, so that's 2,000. We've redeemed at a premium of 1015. And we've got issue costs. These are all finance charges of 1,000. And that's it. The principal is not a finance cost, it's just the money we owed, and the sum of these is all the finance charges that have gone to the P&L, and if we added those up, it would be those 8,815. Right, that's it. That's the more complex example. Let's take a look at the next one.